Hello, everybody, and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. My name is Jesse Day, and before we get started, standard disclaimer, nothing here is investing advice. Do your own due diligence. And today's guest is the founder of the SRSrocco Report and an independent researcher who focuses on precious metals, energy, mining, and the economy, and whose work has been featured on goldseek.com, the TF Metals Report, Zero Hedge, and more. Mr. Steve St. Angelo, it's great to have you on the show.
Jesse, it's great to be here, and there's always plenty to talk about. So it's a pleasure to get to chat with you.
Absolutely. And let's dive in first, like I do with all new guests, and that is with the origin story. So how did you first discover investing? How did that lead you to precious metals, energy, and mining, and ultimately to forming the SRSrocco Report?
Well, Jesse, I've always been very curious. And so when you start looking and asking questions, about 25 years ago, I realized, like many people in the precious metal community, that, the debasement of the currency, increase of debt, and this was going to impact the value of fiat money. And so the best way to protect that is into precious metals. So that's how I started. And I got into precious metals. And I've said this several times, that I purchased my first 100-ounce bars of silver back in 2002 at $4.58 an ounce. And so then I got more interested in learning about precious metals. But then I wondered, how are these trading? So I started researching that these precious metals, gold and silver, were based upon what it costs to produce them. And then when there's a lot of speculation, that pulls the price above that cost of production trend line. And so we get to see the volatility in the metals. And so then I wondered, well, what is the major impactor of the cost of production? And it's energy, whether it's labor, whether it's materials, or energy. And so those are actually all components of energy. And so then I started to really understand what was going on energy, because unfortunately, the economists, the financial industry, kind of disregards energy, especially for considering what GDP is going to be. So that's when I got very interested in energy. And even though I continue to focus on precious metals, because they're an excellent store of value and wealth, and the mining industry, especially the precious metal mining industry, my main focus is more move to energy, because that is going to change the world as we know it, and it is already. It's just starting to. So that's in a nutshell the reason why I focus now more on energy, even though I'm a big precious metal investor.
Well, let's talk about energy, and specifically the energy cliff, and why you think it will destroy fiat money and inflated financial assets. Could you walk us through that?
Well, we all know fiat currencies all collapse. So the biggest question is when. And I think my analysis suggests it's going to be due to the problems we're going to have with energy. That's going to really speed up the collapse of fiat currencies. And not only fiat currencies, a lot of the financial assets like treasuries and bonds and debt that's out there. And so the energy cliff is, my analysis is an offshoot from Lucas Seneca, who did the Seneca cliff. He was an ancient Roman philosopher. And he said that growth in the economy is slow and sluggish. It peaks, and then it really declines. And he calls it the Seneca cliff. And so when I look at the major energy production in the world, it's oil. That allows all other energy sources to be processed, mined and processed, like coal, natural gas, and even the other energy sources. So when that gets into trouble, we're going to start going down this cliff. It's going to be cliff-like declines. And so this is what my analysis suggests. And unfortunately, Jesse, the world is not prepared for that.
Right. So what are the ultimate results of the energy cliff? What does it look like? Is that just a massive reduction in newly discovered oil, leading to a reduction in the ability to provide energy? What is the energy cliff when it occurs? And what does that mean for humanity?
Well, we already saw that with Europe in 2021. They hit the energy cliff in natural gas, and I have a chart showing that the two regions in the world that are the major net importers of natural gas are Europe. They're number one. They're the most, and then Asia is number two. And then everybody else, I think Central and South America is even. And then the other countries or regions, especially Russia and the CIS states, they are the ones that do all the exporting. And so it wasn't a coincidence that Europe got into trouble with natural gas first. And so then what happens is you get high prices. After the high prices, you get kind of, I call it, you go from shortages, low prices to surpluses. And that's exactly where we are now. So when you hit this energy cliff, this kind of energy scarcity now that we're in, it's very volatile. The prices are going to be extremely volatile on the way up and down. And unfortunately, as time goes on, less energy is going to be less goods and services and less employment. And unfortunately, the world really doesn't know what that looks like because we've been going up for hundreds and hundreds of years, increasing energy production. And so I think this is kind of the dynamic that, unfortunately, most of the investments in the world are, and investors are invested in the wrong assets. I hate to say that, but when you look at the data, that's exactly what the world is facing. And so that's why I try to put this information out and warn people what we're facing.
Well, you mentioned at the top of the show, as well as on Twitter, you've been talking about how economists and analysts often ignore energy in their forecasts and that this is a huge mistake. So I want to read a tweet you made. It says, what brought the US and the world out of the depression that started in 1837 wasn't the 1848 US gold rush. Rather, it was the 60% increase in global coal production during the 1850s and a massive 86% increase during the 1860s. Most of the global coal production increase came from the United States, predominantly in Pennsylvania. Coal was the energy that fueled the industrial age. Gold and silver are stores of energy, but we can't put the cart before the horse. Can you expand on that for us and walk us through the importance of factoring energy into economic forecasts?
Yeah, and that's so true. And it's gold and silver really aren't a store of energy. They're not a battery. They're a store of energy value because that's what the world is. We burn energy, produce goods and services, and gold and silver tend to store this energy value that's so important to the global economy. That was a tweet I debated with Hugh Henry. And Hugh Henry was kind of a famous hedge fund manager that you saw on CNBC back in the 2000s. Then he kind of left the industry and he's come back recently. And he talks a lot about finance, and he's a very smart guy about finance and all these different things, the financial aspects of the economy. The thing is, he said that it was the gold rush in the United States that brought on all this gold, this money, right? And that was what brought us out of the Depression. And you see, that is a typical kind of thinking of someone who doesn't really understand that it's the energy. So I said, you can't put the cart before the horse because the horse is the horsepower that pulls the cart. Back then, it was coal. And so when you increase global coal production 50% in one decade, and then 86% in the next decade, that is what was the major driver that pulled the world out of the Depression. And this has happened over and over. Same thing in the Depression in the 30s. It wasn't Roosevelt's New Deal that pulled us out of the Depression. It was U.S. oil production growth. And so, unfortunately, a lot of these financial analysts and economists tend to ignore how important energy is in the economy.
So we are seeing less oil production in recent times. A lot of that is due to ESG regulation. A lot of it is due to situations like the Biden administration openly, seemingly attacking the oil industry. So a lot of these companies don't want to go explore for new oil. They don't want to drill for more oil. They're actually buying back shares, paying dividends, and just trying to keep shareholders happy. Are we reaching peak oil? Because that's a thing that's been brought up many times in the past. I know I've heard that the Permian Basin, where a lot of the shale oil revolution took place, is in decline. And, shale oil kind of revitalized the industry for many years. But a lot of people, I believe, including yourself, see that it could be coming to an end. So how does this whole situation resolve itself? Is there more oil to be found and explored for in other parts of the world? And eventually CapEx will be brought online to do that? Where is all this headed?
Jesse, we could spend an hour just on that question. But to summarize, the reason why we're going to hit this peak. And now a lot of people I see on Twitter and social media, they say that, peak oil, they've got it wrong forever. They keep saying peak oil. The thing is, M. King Hubbard back in 1953 forecasted the peak of U.S. conventional in 1970. And we hit peak in 1970. Well, we brought on shale, but that's unconventional and has a much lower energy return on investment. And up until recently, it's lost money. He went on to say, and many other peak oil analysts said that the global conventional, I've got a chart, I think, that I show that global conventional, which is the good quality, high quality energy, that really is what runs the global economy. It peaked in 2006. It went back up, and then it tried to surpass that in 2016, but it didn't. And then by 2019, it had declined even more. But what's made it up is oil sands, heavy oil, and light tight oil and condensate. And so, interestingly, since the 2008 financial crisis, 80 to 90% of global oil growth came from the U.S. shale industry. And so when you understand that GDP is really a one-to-one relationship to energy growth, we can thank the United States shale industry. And so now I have another chart showing the global oil industry has hit the Red Queen syndrome. You go back to 1965, we were producing about 40 million barrels a day, 35, 40 million barrels a day. Well, the decline rate was about 1.3 million barrels a day. That's it, a year. You lost that every year. Well, we kept adding a lot of oil coming from the Middle East and elsewhere in the United States. So now the annual decline rate, and this is the natural decline rate if you don't do any more exploration or drilling, whatever, or completing wells, it's 10 to 11 million barrels a day. That is 10% is lost of our 100 million barrels a day every year. This year, next year, the year after. That, and of the 10 to 11, the United States accounts for about 40% of that because shale declines 45% a year. So we lose 3.5 million barrels a day just from shale oil. And so this is the problem that the world isn't really focused on. And so we're going to remain in a plateau. But my analysis suggests after 2025, these declines are going to really start to kick in. And lastly, you mentioned about ESG. And yes, it is true. The world is putting more money into wind, solar, EVs, and all that. So yes, it's not going into oil and gas, but when it was, and I have a chart, but I don't have it here, but I went by every decade showing how much we found and how much we consumed. We've been living off of past reserves for decades, not just recently. So we are now basically burning 5 barrels of oil for every 1 barrel we find. And this was even 10, 20 years ago. It was a little bit better. It was maybe 4 barrels we burned for every 1. So it doesn't matter if we spend a lot more money. We're not going to be finding a lot more oil. And one of the big sweet spots in the world is Guyana. And we have Exxon there and Hess and other companies. So far, in the last several years, they found 11 billion barrels. Let's say they double that and they find 20. The world consumes 30 billion barrels a year. That's a 9-month supply. So in the whole scheme of things, even if we find more oil, we are burning too much every year now to be able to sustain that. So that's why we hit the energy cliff. And so this is what I'm trying to get people to understand. The Red Queen syndrome is really tough to offset that in the next several years.
So this sounds like it could have pretty dire implications, but for investors, is now a time to be looking at the oil and gas space because sentiment in the sector is quite low. But, all the data that you're presenting along with research I've done myself seems to point to the fact that fundamentals look very bullish over the mid to longer term. The bear case generally stating that a global recession, which a lot of people believe is coming, will kill oil demand and keep prices low. So what's your view on investing in the oil and gas space at this point in time?
Well, when we understand that we added 12 million barrels a day of growth since the 2008 financial crisis, most of that was shale, and that is getting ready to peak in the next year or so. Unfortunately, there's really not a lot of growth elsewhere. There could be 1 or 2 million barrels a day, but that's really it. And so the issue we're facing is as we go forward, we're going to start to see declines in oil production. And it's all, guess what? It's also going to pull down coal production because China's economy is 50% of it is run by burning coal. That's how it powers its electrical, and it makes its steel and cement by burning a lot of coal. They only could do that if they have enough diesel to extract the coal and to transport the coal and to run their coal-fired plants. And so the issue that we're facing now is that the world is heavily invested in financial assets that have separated from the physical economy. And this is the problem because a lot of these financial assets, like even real estate, bonds, and stocks, are considerably overvalued based upon the physical economy. And unfortunately, Jesse, the world hasn't quite figured out why that's the case. And that's the reason why I believe we're going to see a lot of investors be forced to move into precious metals to protect wealth. And to summarize, let's just think of a bell curve. It's not going to be that way, but you can build wealth. You hear a lot of people talk about, like Robert Kiyosaki, building wealth through real estate and owning businesses. Well, yes, you can do that. When your oil production, your energy production is going up, that's when you build wealth. When it starts to peak and decline, for most people, some people can, for most people, you can't build wealth. You're in a decline. You have to try to survive on less energy and goods and services. So that's when you transition to protecting wealth. And so most people, even the precious metal community, doesn't understand that. And so this is the dynamic I'm trying to get across. We're going to transition from building wealth to protecting it. And really, one of the few places you can do that is in precious metals.
So you're bullish on precious metals in this scenario, but does the energy cliff present an opportunity in oil and gas equities? Do you think those will see a rise, as well as the price of WTI crude and other fossil fuels related equities potentially?
Yes, you see, there's this idea that a lot of these analysts, and I watch a lot of different analysts, financial analysts, and talking about the recession, right? We're seeing the CPI go down, and so everything's going to go down. Oil is going to go back down to $10, and so this is the idea. Due to weaker demand, we're going to have less demand for oil. That means lower prices. Several things have changed now. The world has to be run at a certain amount of energy, just to keep the lights on, just to keep food and goods moving around. And so the issue is, I believe in the second half of this year, especially the fourth quarter, demand is going to outstrip supply. So I think the idea that we're going to see the Federal Reserve start to lower rates, I think we're going to be hit with the next round of energy cost push inflation. Because if you look at the CPI numbers, it was a peak 9% and it came down. If you just take the oil price chart and overlay it, that's where the inflation came from. It was, I call it energy cost push inflation, and happened in the 70s as well, because oil went from $1.80 in 1970 to 36, 20 times. And so that really impacted inflation of everything. So going forward, yes, energy stocks are going to do well. The problem is which ones. This is not investment advice. It's going to be difficult for shale, because the problem with shale is they're going to start seeing a decline in production. So how do you invest in a company that that is going to start having a decline in production? Because basically stocks are growth. The place I see a better opportunity may be in the Canadian oil sands or the Canadian oil gas industry. But there's going to be, I think the majors are going to do well for a while, but this is more of a trade. If people are going to be in the energy industry, I think they need to be in when they're low, when the oil price is low or the natural gas price is high, and they need to kind of transition out when you get a peak. I don't think the oil industry should be a buy and hold. And so this is how I look at it. But I do think, Jesse, we're going to see much higher energy prices towards the end of this year and into 2024.
What are your thoughts on uranium and nuclear energy as a potential solution? You know, it's gotten the green light from the EU as a green form of energy. We're starting to see countries all over the world build out new reactors. Small modular reactors are starting to be considered planned in a lot of different countries as well. Is this a situation where there won't be able to be enough reactors built in time to perhaps replace the lost oil production with nuclear energy in the ways that that can be done? What are your thoughts there?
And again, this question we could go off for half an hour because there's so many details behind it. Well, I do agree nuclear is great base. The two greatest base powers that the world, electricity that the world has used for, 100 years, it was coal, and then nuclear came on like in the 70s. And nuclear is very stable, right? And so has coal been. But a lot of the Western countries are reducing coal due to pollution and all that. The issue is now the high-tech components that go into a nuclear power plant or a small modular reactor or even thorium. Thorium is still, the technology on thorium is still not, has not been proven yet on a commercial basis. All these things, if we're going to do them, we should have done them 20, 30 years ago. So when you hit the energy cliff, we have to remember what happened during the pandemic and after the pandemic. When the crunch hit, you couldn't get things. The supply chain broke down. So a lot of the high-tech components that we need to put in nuclear power plants, whether it's a large nuclear power plant or a small nuclear power plant, the global supply chain is going to have trouble providing those parts. And this is the issue. And the problem too, Jesse, is the global economy, supply chain is fueled by liquid fuel, which is diesel. It's not fueled by nuclear or electricity. While you can put an EV or even a bus, it's very difficult to put an EV commercial jet or a massive ship that hauls goods. You can't put that electric. And so this is the issue. Even if we did go to more nuclear, it doesn't solve. The global supply chain is powered on liquid fuels. And this is on the unfortunate dynamic and then lastly, the infrastructure in most of the Western world is getting old. You put new nuclear reactors, we have to spend over $1 trillion just to upgrade the US electric grid. And we're not going to have the energy or the money to do that. So these are all big problems that really there aren't any good solutions.
Well, you've noted earlier that gold and silver are stores of energy equivalent value and that you're bullish on the space. You know, we're seeing trust erode in the financial system. Government debt continues to skyrocket. So I wonder what role you think gold and silver as well will play up ahead. Will we see another gold-backed currency? Obviously, the BRICS nations are getting together. There's talk of an announcement. The Russian embassy in Kenya already tweeted out that there will be a gold-backed BRICS currency. It's Twitter. I don't know how much you can trust a single tweet like that. But do you think that's something that's going to occur? And how do you see gold and silver? What is their role up ahead?
Well, you see, the world, especially after the 1980s, we went on the petrodollar, right? And so you need dollars to do a lot of trade. And it's a wonderful monopoly. And I think that will continue for a while. But again, we're starting to see countries start doing some amount of trade, a move away from that. The issue is to fund our debt in the United States and around the world. Other governments have done it too. We have issued treasuries. And so I've got a chart showing the cumulative account deficit in the United States and the M2 money supply. And by God, Jesse, they go up, especially in the last 10 years, they're going up in the same fashion. So the money supply has come from financing our debt. People believe it's the Fed doing it. No, it's the US government issuing treasuries to cover our deficits, as well as other countries around the rest of the world. And so we aren't settling trade. What happens now, we've got all these bonds and treasuries out there. Plus there's the shadow banking system has a lot of money, dollars out there floating around. So the issue is that has taken off away from the physical economy. And now that only works if you can increase energy production. It starts to really fall apart when it peaks and declines. So what's going to happen, debt's going to implode. And if debts implode, the assets on the other side implode. That's stocks, that's real estate. So investors are going to think, wait, what's going to happen? If you just continue to see falling real estate, I think this was the last real estate bubble the world's ever going to see. That was it. What's going to happen when we start going down this energy cliff? You're going to have to, like I said, protect your wealth. You can't do it in real estate. You can't do it in a treasury, especially the longer dated treasuries and bonds, because they're basically IOUs. It's a promise to pay. And that's what is backed on our currency, the dollar, as well as many other currencies. So this is kind of still being held together due to all the debt and the money printing and the treasury issuance and the bond issuance. But that really starts to implode as we head over this energy cliff. And so why does gold and silver? The question is, why does gold and silver protect wealth? Because it takes 100 times more energy to produce an ounce of gold than it does an ounce of silver. Gold and silver have been money for thousands of years due to their store of energy value. Nothing has changed. We just forgot about it because we transitioned to a paper money system and digital money because it was more efficient than trading coins and things like that. But we have blown out, we have inflated this well beyond anything that the energy can support it. So that's why gold and silver protect wealth. And the thing is, it's one thing to be a store of energy value. It's another thing to be the foundation as investors move in out of real estate, bonds, stocks. I have no idea what the values and the prices of these metals are, but I think we're going to see much, much higher prices due to the world trying to protect wealth in an energy scarcity environment.
And speaking of skyrocketing debt, how does this situation get resolved? You speak of a debt implosion. You would think that the government's issuing all this debt, central banks would be able to see this situation up ahead, and yet they're running record deficits while shoveling money into the Ukraine war machine. It seems like a bunch of complete lunatics basically in charge of everything. So how exactly does this debt situation end? Do you think the people in charge are just so ignorant? Perhaps it's ego, perhaps it's hubris that they can't see it? Or do you think it could be, this is getting a little bit more into a political, philosophical angle, but do you think it could be malevolence? Why do you think they want to collapse the system to potentially introduce something else? What are your thoughts there?
My thoughts are probably a little bit of everything, but what is really guiding the money printing and the deficits? I have a wonderful chart showing the debasement of the Roman currency, the silver denarius. So most people say the fall and the collapse of the Roman Empire was due to the debasement of the currency. So if you don't understand energy, you're an economist or financial person, you put the cart before the horse. You blame it on the debasement of the currency. The issue is, in the Roman Empire, they were cutting down forests because back then you cut down trees, you made charcoal, and you smelted metals. That's the way you produced metals. They were running out of the easy to access wood. That's why they went up. And I talk about this many times. The movie Gladiator, you see the battle in the beginning is that they're in the big forest in the Germanic area. Well, that's where the wood was. So they were going after the wood. Well, there's a chart showing the collapse of wood production in the Roman Empire, especially after 200 AD into 300, 400. When you have the collapse of wood, you have the collapse of your silver production. So to keep the circus of the Colosseums and the economy kind of limping along, they debased the currency because they didn't have the silver supply. And so we're doing the same thing now. But instead we're trying to offset what I call the falling energy return on investment of oil and other energy sources. And so part of it is the central banks, the leaders, the grift because the wealthy are becoming wealthier. But a lot of the U.S. deficit is to fund people's Medicare, Medicaid. It's really for regular people too. And so we're trying to keep the lights on as the energy gets worse and worse. And so they're putting fires out by doing more debt adding more treasuries. But now it's going to come back to haunt them, especially as they raise interest rates to 5%. It's destroying everything now. You can't have, you see, why do you have high interest rates? If you have high oil production growth percentage. If you're growing your oil production like they were in the 60s, 10% annually, you can have 10% interest rates. When you are only growing oil in the world at half or 1%, you go to 5%, you have to print that 5% interest. And that's what they're doing right now. And so when energy production declines and you start going into negative production, the GDP falls and all that debt and money, all that starts to implode. So that is how the system starts to unravel. Unfortunately, good or bad, the central banks are trying to put fires out. And as they put more and more fires, it's more and more leverage. And they're just going to get into serious trouble when this energy kicks in, this energy cliff. And that's really the best way to describe it. So that's why I focus on energy. I don't focus on the other symptoms because the energy cliff is going to pull down all these problems. Unfortunate, all this debt and leverage. So that's how I see it, Jesse.
So I want to touch on another tweet you made where you said, we must remember the stock market does not start to really decline until the Fed lowers rates. We are nowhere close to that yet. I've heard a few other people echo similar sentiments, but the majority of people I speak to say the Fed will be forced to cut rates, maybe even later this year, despite what Powell is telling us and their hawkish stance. How long do you think it could be before they eventually do cut rates? Is this going to be a higher rate for longer environment?
I think the best way to answer that is if my analysis is correct, and I believe the people who I follow in the energy industry, they're different than this recession is going to really pull down demand. It will, but there's so many other countries like the Middle East last year, it increased its consumption of its own oil by 10%. And so even during a slowdown in, let's say, the United States or Europe, they're still consuming oil in the Middle East like mad. And Indonesia is consuming more energy. And India, in May, they had the record amount of petroleum consumption. So where's the decline in demand? See, a lot of other countries now they're building more cars in India. They want to drive around just like us Americans and in the West and in China. And so I think this idea that demand's really going to fall is going to be a nothing burger. And so I think we're going to see higher energy prices. And who knows if the Middle East, Saudi Arabia, OPEC decide they're going to cut more. They could, and they control the cards. The Middle East and Russia and the CIS states, they control most of the surplus energy, oil and gas. They control the cards. So if we see more energy cost push inflation in the second half, fourth quarter, I think Powell is going to raise rates even more because inflation's going back up again. So I think this is the dynamic. I don't know when the Fed is going to, let's say, stop raising rates and then start cutting. If they do cut it sooner, then they typically cut when the market is really starting to decline. That's during the recession. But we're really not seeing the recessionary forces quite yet. They'll probably start in the second half of the year. So I think if we get higher inflation, Jesse, we could see the rate hikes remain high or even go higher.
Well, Steve, thank you so much for joining us today. A ton of wisdom shared. I love talking about energy. It doesn't happen enough on this show, and you've given us a very unique perspective and something to consider. So thank you so much for that. Before I let you go, for those who want to learn more, could you tell us about the SRSrocco Report?
Yeah, Jesse, thanks. I'm on Twitter, SRSrocco Report, and I also have the SRSrocco Report website where I've got some free member posts, but I've got the gold and silver subscribers, and that's where I really take the details. I try to put out how the details are changing. I just did a report on the U.S. shale gas industry, and I think we're going to start to see a decline in U.S. shale gas production due to the massive decline in gas rigs, drilling rigs. And so I try to put the details out to let investors and my subscribers know what's happening with energy, because what's happening with energy is going to transfer what happens with the mining industry, with the economy, prices, and also with the precious metals. So that's what I like to do. I spend a lot of time doing that. And so I do appreciate you giving me the opportunity to share this information with your followers.
Great. Well, I'll put links in the description below to both your Twitter and the SRSrocco Report website where people can check that out. Thank you once again for joining us today and sharing all your knowledge with our audience.
Thank you very much, Jesse. Hope to do it again. Maybe we should do this again towards the end of this year to see how things played out.
Absolutely. Looking forward to talking again.
Thank you.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.